What's up, everyone? It's Caddy with Money Vesting. So we've got a big inflation report coming out tomorrow at 8:30 a.m. Eastern. I will be live to cover that report at 8 a.m. Eastern. So pretty much we will be live. I want to be clear, I'm not going to get the report at 8 a.m., but I will be live at 8 a.m. The report's going to come out at 8:30 a.m. Eastern. We're going to break that down, and we're also going to see what the market's reaction is going to be. Now, a couple things that I want to mention. Number one, with this banking crisis that we are going through right now, this can be seen as a little bit more inflationary in nature because of the quantitative easing part of this entire soft slash no bailout, right? So I don't know how to kind of put it in words because, as I mentioned in my other video, this is not a government bailout to Silicon Valley Bank or Signature Bank, but it's just making sure the depositors are made whole, right? The depositors, companies, individuals that had money in these banks are made whole, and they don't kind of run through their problems of not being able to pay their employees, not being able to make payrolls or working capital, or paying their lenders, or paying their sort of suppliers. So they're just making sure that the depositors are made whole. But if the company of Signature Bank or Silicon Valley Bank are holding on to such severe losses, right? Even if they sell them for parts, they're not going to recoup anything from these banks. And as a result, a lot of the money that's going to be given to these companies back as part of their deposits is going to come from FDIC. And if not, it's going to come from a lot of Treasury Department and the Federal Reserve as well through quantitative easing. A very small injection of capital to make sure that these depositors are made whole and the money pretty much is available for them. Now, of course, we've seen a lot of liquidity shift here. I mean, lots of regional banks getting outflows and a lot of it's consolidating into the big four. But the focus for today is really going to be inflation and CPI because tomorrow, 8:30, we're going to get that new print for February. And I'm going to go over some of the things that I think are going to be really important and how the Federal Reserve might see this moving forward. Because as I've already pointed out, the inflation is a leading indicator for everybody, for the Fed, for the economy, for the market, even though it's a lagging indicator. And I know it's a lagging indicator because we're getting the previous month's report. It's a leading indicator in a way because the Federal Reserve is so data dependent. They are strictly looking at inflation numbers to pretty much telegraph what they're going to do next with respect to interest rates. And March 22nd is when the next meeting is, but CPI reading takes a temporary backseat to banking crisis. Silicon Valley Bank collapse supersedes inflation right now, is what Bloomberg also reported, which I somewhat disagree with. I think inflation is going to be just as important, if not more important, for the markets than anything else. And these are some of the CPI estimates for tomorrow as put together by Gurgivan and Stifel here, 5.8%. Very optimistic. We got UBS 6%, Wells Fargo at 6%, Credit Suisse at 6%, HSBC at 6%, JP Morgan 6%. We got Morgan Stanley at 6%, Scotiabank at 6%, Nomura 6%, Goldman Sachs 6.1%, BMO 6.1%, Bank of America 6.1%, CIBC 6.1%, and TD Securities and Visa at also at 6.1%. So the median estimate is 6%, which is quite optimistic in my opinion. And Kathy Wood tweeted about 13 hours ago, if the Fed continues to focus on lagging indicators like the CPI and does not pivot in response to the deflationary forces telegraphed by the inverted yield curve, then this crisis will devour more regional banks and further centralize, if not nationalize, the U.S. banking system. And what we're really seeing is a lot of consolidation towards big four money market accounts. By the way, I will go over this entire thread. It's pretty long, so I will go over all the details and everything that Kathy Wood talks about in this tweet. But the bottom line is, yes, CPI is a lagging indicator, no doubt, but the Federal Reserve has put out so much weight on this print, on the CPI numbers, that it is starting to become a very leading indicator. In other words, when CPI comes out, then the market starts to anticipate what the Federal Reserve is going to do next, right? So even though theoretically, yes, it's a lagging indicator, but for the Federal Reserve, because they're so data dependent, it's starting to be very much of a leading indicator. Now, when it comes to the CPI numbers for February 2023, month over month, the expectations are for us to see a gain of 0.54% on a month-over-month basis, and for year-over-year for us to come down to 6.2%. This is from the Federal Reserve of Cleveland, so Cleveland Bank. 6.2% is the estimates, and core CPI to stay a little bit higher at over 5.5% is going to be that estimate. Now, let me tell you this. Since the banking crisis has begun, there's been increased talks and debates and discussions and anticipation that the Federal Reserve is going to take its soft and is going to pull back. It's going to take its foot off the gas, and they're going to literally just tap out on their fight to inflation because of this being a breaking point. I'm not advocating for higher interest rates. I'm not saying that we need higher interest rates. I want to be very clear, but we literally just had the testimony of the Federal Reserve last week. 2-day testimony, right? Wednesday, Thursday, I think. Or it might have been Tuesday or Wednesday. I can't remember. But bottom line is, it's been less than a week. It's still fresh. And Jerome Powell literally said that rates are going higher for longer. Rates are going to be higher than what we previously anticipated. And rates are going higher faster than what we previously anticipated. In other words, the pace and the magnitude is all going to be higher than what they previously anticipated in their SCP back in December. So bottom line is, despite what we're going through with the banking crisis on Thursday, Friday, and over the weekend, and of course getting some resolution over the weekend from the FDIC, the Federal Reserve, and the Treasury Department, the government stepping in and kind of backstopping all those depositors, and unemployment staying as low as it is, retail sales still came in strong. We still have a lot of manufacturing data, inventories, and construction spending, all of that still looking pretty solid. And inflation staying as high as it is, 6.2% expected from Cleveland Fed, 6.2% year over year, and 5.5% on a core basis. I still do expect for the Federal Reserve to keep hiking rates, at least another few more meetings, couple more meetings, I should say, for the Federal Reserve to keep hiking rates of 25 basis points. Again, I'm not advocating for it, but I'm just kind of reading between the lines and what the Federal Reserve has literally told us less than a week ago and what's transpired and what has been the resolution for all these things. Had the Treasury Department and the government not stepped in, this would have been a much bigger contagion. It would have been a much bigger systemic risk for the entire banking industry. And then, yes, there would have been, no doubt, there would have been the Federal Reserve pulling back and taking a more dovish stance, considering that this would have been a contagion and a lot more banks would have fallen apart by now. But since there's been a restoration of that stability and that confidence from the government, I think the Federal Reserve is going to still go on their path to raising rates. I could be wrong. If I am wrong, that'd be great for the markets, and we would still be, bullish, and I would still be long, and I would still be holding on to my long-term portfolio. We'd be crushing it. However, I just want to read between the lines and make sure that you guys understand that if for any reason the inflation numbers, once again, if the inflation numbers come in super hot, we're done, right? We're toast, because Federal Reserve at that point is really just not going to stop, because their main goal, on a more isolated basis, is to make sure that inflation stays under control. If inflation comes in with a very, very soft reading, if we come in at under 6%, I mean, that's the expectation, right? 6% is the actual expectation from the analysts as well. So if you come over to this right here, so I don't have that number right here. So this is going to be that estimate, 0.4% expected, 6% on a year-over-year basis. So if we come in softer at 5.9, 5.8%, you better expect the markets to once again anticipating no hikes from the Federal Reserve on March 22nd, because on one hand, you've got a breaking point, you've got the banking crisis, and on the other hand, you've got a softer inflation read. Absolutely. Stocks are going to rally on that news, and in my opinion, the Federal Reserve is going to potentially start looking back on not raising rates. But if, for any reason, if inflation comes in hotter, and we better not be talking about 6.5 or higher, right, on a year-over-year basis, if you actually take up, it's going to be a problem. It's going to be a problem for the markets. It's going to be a problem for the economy. It's going to be a big problem for the Federal Reserve. So those are the type of lines that I'm thinking in terms of, like, when it comes to inflation. And again, that's the optimistic target. We've got the base case, and the bear case is very much going to be above 6.4%, above 5.6%, month over month above 0.5%, and bull case is going to be anything that's less than that, less than the base case, and of course, if you see less than 6%, that will most certainly be the bull case. So it's not so much about the base case optimistic in this going into the sprint. I think it's a lot about the bear case and the bull case. If inflation comes in above 6.4, that's a bear case. Stocks are not going to be happy, and the market's going to once again anticipate a more hawkish Fed. But if we come in below 6%, that is going to be extremely good for the market, and the market's once again starting to anticipate a more dovish Fed, considering the banking crisis as well. So this is where we are. This is a month-over-month and year-over-year numbers. 6.4% was that last print, and we're waiting for February. Let me know your thoughts and what do you think about inflation numbers going into tomorrow. I will be live to cover them, of course. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. And bottom line is, I think it's more of a breakdown between bull and bear case, not so much about the base and optimistic, because that's really going to still keep that uncertainty intact. But if we do kind of hit those extremes, then the market's going to anticipate whether the Federal Reserve raises rates or does not raise rates, and going into the next meeting, whether we're hawkish or dovish. So let me know in the comment section down below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. Happy investing, and I'll see you all in the next video.